Alrighty, good afternoon, ladies and gentlemen. Thank you for taking time out of your busy schedules to join our webinar today for our 2024 Outlook. I'm Cam, I'll be the moderator of the webinar today, along with other team members who will be discussing some of their various aspects. Just a few housekeeping rules before we dive in. This webinar is being recorded and the recording will be shared later on our YouTube channel. If you have any questions, please do put them in the Q&A or the chat function so they go straight to our panelists, and we'll take the questions as and when they come along, but we will also have a dedicated Q&A section towards the end. Before we actually start, a few disclaimers to go through for compliance, so just bear with me. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments may involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. And with that, over to you, Isa.
Sorry. Yeah, thank you, Cam. So, hi, I'm Isa Kettmann, financial planner at Dunhill Financial, and I just want to give you a brief outline of what is important with financial planning and how we can plan the year ahead. The beginning of the year generally is a great opportunity to take a step back and review your financial situation. We've summarized a few points here that are worth looking at to ensure that you're covering all the different pieces. Now, the first and foremost thing to consider is building a net worth overview. You may have multiple bank accounts, pensions, retirement accounts, and you may have no idea how much they are all worth altogether. Of course, we all have kind of like a gauge, but it's always helpful to have a list of the different accounts that you have with their values, so you can be very sure of how much you have where and have a good grasp of your overall financial picture. Make sure that you don't leave out the liabilities, since those are extremely important to also consider, and putting this list together with the liabilities can be a good opportunity to see if there are some that you could actually pay off, so you save some money on not paying costly interest on them. Another thing to consider is a cash flow overview. This can be really helpful to kind of put the balance in between what are you getting in monthly income and what are you actually paying in expenses. That gives you a better idea of how much you have left every month or where you may have shortfalls. We always recommend that you also have an emergency fund that should be expensive of about 3 months. Now, naturally, in order to have that emergency fund, you need to know what you're spending in a month. So that's always a good idea to kind of have a look what you're spending, how much you're getting, to get an overview there. Retirement and pension contributions are extremely important to make sure that you are prepared for your retirement later on, to build up that financial plan of yours. And you may have company pensions that you can contribute to. Make sure you look at how much you're contributing or whether you can actually contribute more. IRA contributions are also a great opportunity to save on a tax-deferred basis or get some tax cuts on your annual tax filing. So if you don't have any retirement plans and you're unsure what might be a good option for you, make sure that you speak with us, since we may have some recommendations on where we can optimize your financial plan there. Tax deadlines are also always good to know. Naturally, there is the tax filing deadline, but there are a few other deadlines that you may want to keep in mind. For example, you can contribute to your IRA until April 15th in the following year. That means you have until April 15th of this year to contribute for 2023. There are other deadlines, like, for example, if you have an inherited IRA, make sure you know when you have to distribute the depending on when you inherited the IRA, this may be within 10 years. This may also be for the rest of your life. But that would mean that you then have to take annual distributions. So make sure you're aware how your account functions there. Generally, we all have goals, and we all want to make sure that we can meet our goals. And in order to meet your financial goals, having that financial overview, kind of having a grasp of where you are in your financial plan is going to be incredibly helpful to put together a step-by-step plan and make sure that you get to where you want to be. If you need any help with that, do let us know. We are here to support you in building and maintaining your financial plan.
Perfect. Thank you so much for that, Isa. Perfect. Thank you so much for that, Isa, on the planning aspects. And with that out of the way, we'll jump right into our outlook for the year. We've got quite a bit to unpack here, with a lot going on the geopolitical scene, the markets, and everything else in between. But before we dive into that, moving on to our next slide here, markets are actually at all-time highs, surprisingly. So before we dive into what we've got here on our screen, Brian, and why don't before you take us through the slides and what's going on, we've got a poll here for our audience, which we'll jump right into. And as I'm doing that, Brian, why don't you explain why markets are all-time highs, why it's not necessarily a concern, and what is the chart here that we're looking at?
I'll actually retract one of your words in there, Cam. Surprisingly, we shouldn't be surprised that the stock markets are on all-time highs, because most of the time they are sitting at all-time highs. Right now, what's surprising is how fast they're continuing to hit new all-time highs. This is our third day in a row, and the markets are up again. So we're getting close to what most analysts' forecasts were for 2025, but just at the first part of 2024. So we've shifted and we've moved considerably. Now, why we shouldn't be surprised that the US markets in particular, so what Cam has displayed here is the S&P 500, have done so well. And it's mostly based on the backs of 7 companies that are predominantly called the Magnificent Seven nowadays. One of my favorite statistics that I've seen just lately is that if you look at the earnings of just those 7 companies, it's the equivalent of the market cap of the tech sector during the dot-com boom. So these companies are making a phenomenal amount of money, and that's what's really driving the market. They're in a sector that can grow. Anybody that followed Davos last week might have heard after Sam Altman's speech, several people commenting, can we talk about something other than AI? But when it comes to the investment universe, I don't think there's a need to talk about anything other than AI. Microsoft is now the biggest company in the world. They've overtaken Apple because of AI, and that will continue to rein in as an opportunity for the S&P 500 to grow much faster than ever. Now, is the market over? Is it expensive? Absolutely. When we look at this chart, the aim of this chart is to show us what the average should be of the Shiller price to earnings ratio over the course of time. So a great metric of looking at what the value of the overall stock market is. And when it gets well over 1 standard deviation, it shows that it's really expensive. As you can see right now, we're 1 standard deviation away. So it looks a little bit more expensive than we'd really like, but we're going into a potential hyper growth session. Last year, we saw lots of cuts on costs for companies. We saw that with over 250,000 layoffs when it came down to those tech companies. We're starting to really see those coming through in the financial companies as well. Big layoff announced by Citigroup yesterday, or 2 days ago, sorry. But on top of that, there's the question of whether the dollar is going to finally be coming down. We'll really dig into currencies later, but a cheaper dollar means that 60% of revenue when it comes to tech companies and 40% when it comes to the rest of the S&P 500 will come in at higher levels on the S&P 500, therefore making that PE ratio, that Shiller PE ratio, that much cheaper. So are things more expensive than the 25-year average? I'm sorry, it's the 30-year moving average. Yes, they're more expensive. Do they deserve to be? Absolutely, because of new opportunities out there and new potential for that earnings growth to increase based on the back of revenue growth and also cost reduction after all the last year's cuts. It's not ridiculously high like back in the dot-com boom or back in 2019, but it could easily get there if we still have a lot of growth for the year.
Excellent. And I think the audience has just completed the poll here, so we'll share that, which actually is a great segue into our next slide here. So surprisingly, or I should say maybe not surprisingly, if the next slide is any indication, most of our audience thinks that the markets are going to be up for the year. What do you make of that, Brian and Josh?
Well, 70% of the time we're right by just predicting that the markets are going to go up, i.e. on average, the markets are up 7 out of every 10 years. So I think that's going with the odds in our favor in that regard. And we have an optimistic group. You know, naturally, that's a good tendency of those that take part.
Speaking of optimism, sorry to cut you off there, Brian. Optimism actually has rebounded quite a bit, especially when we look at the US Michigan consumer sentiment here, which is what we've got. What's actually happened here, and how does this reflect into the market dynamics potentially?
Well, let's go to the next slide and show the Michigan Consumer Sentiment Report. This is one of those reports that has to be followed very closely for economists. It really doesn't mean all that much, but it means everything of where people see things. Typically, so they're looking at basically polling 1,000 people each and every month, and they ask them how they feel about the general economy and how things are going to come about. And naturally, as people get more and more negative, that brings more opportunity for the economy to recover. As they get too optimistic, all of a sudden that can be an indication, a leading indicator per se, that things might get overheated. You can see we have had a very negative year. Last year, there was a lot of negativity around we're coming off that bottom, but we're still below our averages. And I think that's important to point out because we're going into a historic year. This year, we expect a lot of bad news to hit. And I think Josh can tell us a lot about what we should expect with the biggest electoral year in history.
Absolutely. Yeah, perfect. Get that up on the screen. Great. So this all relates to what's going on in the world this year. Now, you're probably aware of at least one of the elections going on. Now, turns out there's about 70 of them happening this year. So it's a big year for a lot of people going to the polls and using their right to vote. Now, Taiwan's elections are already done earlier this month in January with the result of the Democratic Progressive Party winning, which is another term for them. Now,
I thought Cam was going to draw on the screen where Taiwan was. You know, he was playing Vanna White earlier, so
just draw like a big arrow right there. It's near the Ukraine little symbol, just to make it confusing. Anyway, so that's significant because the DPP is a party that, along with its voting base, naturally views Taiwan as a state unto itself and not part of China. Naturally, mainland China, so that is the People's Republic of China, does not look on that favorably, and so that naturally has the potential to stoke some tension in the cross-strait relations between the two. That's to really leave aside the issues that China has at the moment with its own sort of domestic issues, which can temper somewhat the probability of exactly that kind of a crisis evolving, but it can still be a risk that you can't totally count out.
So if we can slow down just for a second, because while I was joking with Cam that he could draw what's going on there, if we look at the eastern board of China, that is where most things are produced, right? And it just happens to be that the strait between there and Taiwan happens to be where most of those goods have to go out to get to the Western world. And therefore, if that strait had some sort of conflict, we would be looking at some major problems when it comes to supply chains. Hence why this is such an important election, and even more so, an important region of the world that would influence the rest of the world.
Absolutely. So that actually ties in really well because, well, if there were to be a conflict at that point, one of the main wild cards is what would the U.S. do? The U.S., as a segue, I'm sure you know, also has an election this year. It's one of the next 70 to come. Now, even after the results in Iowa and New Hampshire just recently, there's still a lot to unpack in terms of the variables. So it's too early to tell what will happen in November. Obviously, we don't have a crystal ball there. But what we can say from a general point of view is that a strong economy and a strong market is likely to be helpful for Biden as the incumbent, whereas any potential weakness or a recession could then be helpful for the likely candidate from the Republican Party, Donald Trump. Now, if you're curious how these races can change over time, every election, to state the obvious, can be different. Just for a bit of background, this time in January 2016, Trump was slightly lagging behind other Republican candidates. I know it seems like forever ago, but if you're wondering, those two were Ted Cruz and Marco Rubio. I know what happened to them, right? Before gaining support over the following months. So basically, to say, while the economy is one of the variables to watch, nothing is set in stone at this point in time there. Now, there are still yet quite a few other elections to take place in the year to wrap this up. Now, you'll likely hear a lot about Russia and India. However, I don't think it's that controversial for me to say that both are likely to have known outcomes, given Modi's popularity in India and the recent growth they've seen, and a lack of viable opposition against Putin in Russia, which I don't think I need to really belabor that point. But the elections with the most implications will likely be, well, the US goes without saying, also the EU Parliament, because that could really affect Europe's, for example, their support to Ukraine and the landscape there in Brussels, as well as with the United Kingdom, with the possible swing to Labour when they have their election. So that's just a few of the different aspects to watch, but there's quite a few more to unpack, but those are the main ones we would say you'll be hearing about and should be following going into the year ahead.
When do we have the European Parliament elections?
That's going to be in June. Sorry, let me get the line up here.
So we've got some here at the beginning of the year, a little bit mid-year, and then the U.S. elections rounding it up.
The big run up to round out the year. That's correct.
And we would expect the economic impact of the U.S. elections will probably be the heaviest. And as you said, if Biden were to get reelected, or I'm sorry, if the economy is to hold up this year, most likely Biden would be reelected, whereas if we had a market slowdown or an economy slowing down, it would be more likely that Trump would get into office.
And consequently, it would affect the wider implications of that as well, because, well, if Biden were to be in office, I think it stands to reason that Ukraine support would likely continue the way it has, although I know lately that's kind of been sort of a question mark. Whereas with if Trump were to be elected, it seems much likelier there would be a significant pullback from the support and the defense aspects there.
Well, so America spends almost as much as the rest of the world when it comes to defense, right?
Right.
I hope that statistic still holds up, and otherwise Cam's going to go ahead and fact check me. Now, Cam, when it comes to the defense contractors, if all of a sudden the biggest spender starts to actually reduce their expenses, we'd probably expect those defense contractors to come down. Are they currently expensive or are they cheap?
Absolutely, Brian. And I think this is something you and I have been having conversations on for quite some time. If we look at the forward P ratios of a lot of those defense contractors, we'll take Boeing to one side because, well, they've got their own set of issues outside of the military industrial complex. A lot of those are trading at historical highs. And if we look at a lot of the pipeline for some of these defense contractors, they are pretty strong. And that's on the back of, as Josh mentioned, funding for the ongoing conflict in Ukraine, but also some of the tensions that are continuing to flare up in the Middle East as well. And even the Europeans actually starting to ramp up some of their defense spending. With that said, if, as Josh pointed out, the elections in the US go a certain way or the other way, defense spending could be called into question, which naturally will impact the pipeline for a lot of those defense contractors.
So a potential place of coming down off highs, if all of a sudden we see Trump, that could be a place that would be hit significantly, and therefore might be a place to hedge from the portfolio view.
Bring it back into, oh, sorry, go ahead, Brian.
Go ahead, Cam.
My apologies. I was going to say, bring it back into going out of the political spectrum and the geopolitics. Why don't we move on to central banks? Because they have had quite the impact last year. And before we dive into the slide here that we're looking at, we'll move on to our second poll of the session here, which is on interest rates. So we'll get that poll up here for our audience. And as our audience is going ahead and answering whether we are getting any rate cuts in the USA in 2024, why don't we unpack what's going on here in this slide, Brian, and what the central banks did last year?
Well, I think if we were to do a roundup of all 4 quarters last year and all of our 12 newsletters, they were inflation, 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 inflation. When's inflation going to end? And inflation 10 more times. And whenever you have mass inflation, interest rates have to be increased to try to curb that inflation. That was the synopsis of last year, and there Cam has given you the numbers of rate hikes that each of the central banks raised rates to curb that inflation. From the looks of it, it looks like it has been curbed in most of the developed world. The US is looking very contained. Half of the countries in Europe seem very contained. And even in the UK, where they say inflation is still a basket case, we're sub 4%. So it's below the long-term averages, but not where they'd like it to be, because most of the developed central banks would like to be around 2%. That being said, now interest rates are quite high compared to where we've seen them for the last couple of decades. And that brings up what expectations would be in 2024. From our poll, it looks like the majority of you believe that, well, we're going to get some rate cuts on the US side this year. Powell is saying we got to get used to higher rates for longer. But we've also got priced in several rate cuts from the Federal Reserve and our other central banks.
Why don't we actually look at that on the next slide here? If I stop sharing the poll, and if we move over to our next slide here. So naturally, we've got the various different central banks here, Brian. We've got the UK, the US, the ECB, as well as Japan there thrown in as a bit of an outlier. We've covered what central banks did last year. Most of our audience agrees we're getting some form of rate cuts in the US. And as I cut you off there towards the tail end, the expectations are for 6 rate cuts in the US and potentially the same in the UK, with slightly less in Europe.
Now put that in perspective, Kim. You're saying 6 rate cuts is the expectation. How many meetings do we have in a year?
We've got 8 meetings. We've got 8 meetings with the Federal Reserve and 8 on the European side.
75% of the time. So basically, the markets are accounting for 75% of the meetings. We're going to have a rate cut. Meanwhile, the message that we're still getting from Powell and the head of the central bank is we're going to stay higher for longer. Right? Just to put that in perspective.
No, absolutely. I think the higher for longer mantra that a lot of these central bank heads are pointing is, again, if we look back to history to the 70s and 80s, I don't think Powell or anybody else wants to be seen as the person that, repeated the same mistakes as the 80s and let inflation take a hold again.
So then in simple form, I guess our mantra then is follow the central banks rather than the market on this one.
as you'll notice from Cam's chart here, in blue, the United States is looking like it would lead the way and lead the first cuts. Now, naturally, if the US brings interest rates down and both the UK and Europe have to hold where they currently are, we would expect the dollar to go down compared to the euro and pound, right? Later in the year, or closer to 2025, essentially, we would expect rate cuts from Europe and the United Kingdom, playing catch up. But naturally, they have to have the data to back that up. So this is where the consensus on the street is that the dollar could be going down in the next year because the rate forecast would actually be the predictor of that. Do you want to go a little bit into the anomaly there of Japan? They met today.
Yeah, absolutely. I think if we'll get to the next slide later of what are some of the key dates to be watching. And as you pointed out, Brian, there's 8 meetings in a year, and the expectation that 75% of those meetings will result in a cut. I think you and I have very differing opinions, or strong opinions, I should say, on that. But speaking of Japan, I think for decades they've tried to actually get inflation back to above 2%, unlike the rest of the Western developed nations, and they've struggled. They've struggled for decades, and now they finally have inflation. So the question becomes: is the easy policy that they've had for the last 2 or 3 decades of yield curve control, i.e., artificially suppressing the shorter end of the yield curve of where that should be, is that sustainable, or is that even needed anymore? And that's why, if we look at some of the predictions here from the OECD, many are predicting that Japan will actually start increasing rates coming into 2024 and potentially finally ending yield curve control. But I think, Brian, maybe you can add to this. I think a lot of people have been speculating on this for a very long time, and they've been proven wrong for many years.
Well, eventually it will happen. It's essentially what it will do to some of these carry trades and such, which doesn't influence the majority of the people on this call, but it is one of the big reasons why we're not sitting there jumping on the bandwagon of trying to buy Japanese right now in these rallies. Essentially, the currency could be influenced in a big way if all of a sudden the Japanese central bank had to change their current plan. So we're probably going to spend the bulk of our time this year really concentrating on what's going on in the developed world minus Japan, instead of taking part in the speculation over in Japan.
And if we go back to some of the dates that we actually have, as you mentioned, there's 8 meetings on the US, the ECB, and the Bank of England side. But here we've actually laid out some of the dates. As Josh pointed out, the Bank of Japan has already met today, and essentially the takeaway from that meeting was they're potentially talking about ending yield curve control. So essentially not a whole lot to go off there. But we've got the January meetings, and then we've got the March meetings. Why don't you give us a bit of context here, Brian, on why March is a key and pivotal point here for a lot of these central banks?
Well, when it comes down to it, I don't think many people expect rate cuts at the early part of this year. And if you're going to have 6 rate cuts in the year, you'd have to have that second meeting in March would have to include a rate cut. So if we don't get that rate cut in March, we're definitely not getting 6 rate cuts on the year. And therefore, we could get a more normalization of our yield curve, because we could actually be in the position that we have to take Powell at his word that rates are going to stay higher for longer. I think 6 rate cuts in a year, especially an election year, because the Federal Reserve does not like to look like they're playing politics. So I think they're going to avoid acting anywhere close to November during the US elections, maybe even anything post-August. And I don't see them acting here or in the March meeting. But we won't know that until mid-March. So we're only left with a few meetings that we'd need to have double rate reductions to potentially get to that 6 rate cuts for 2024. I don't mind being wrong on that. Large rate reductions are going to act as a huge market stimulus, and they'll help the bond markets. But in my experience, election years are not years that the Fed tries to influence and move markets in big ways. Powell is a registered Republican. I think most of the street thinks that he would prefer to see Biden come back in instead of having Trump in office, but he'll tell us none of that, and I think he'll stay away from that.
It's probably a wise move.
Indeed, a wise move all around. So we've got these next set of meetings, essentially, in the roadmap for the central banks. But I think the pivotal question, Brian, as you pointed out there earlier on in the presentation, is currencies. Now, if we move on to our next slide here, we've got the various different key exchange rates between the euro, the pound, the Chinese yuan, as well as the Japanese yen here. If some of these rate cuts play out as the street is predicting, Brian, how do you anticipate that to affect the euro and pound? And secondly, how that would impact the stock market and its valuations?
Well, if we think of the behavior, first of all, most every country would like to have a weak currency so that they can go ahead and sell more. It becomes competitively advantageous for them. Now, the US is in a position, as we were talking about on the increasing of rates last year, that they get to go first. They normally act first, and nobody wants to get in their way because them being the biggest beast out there, you're just not going to get anywhere by trying to actually get in front of the Federal Reserve. Now, if they're going to do the same thing on the way down, which is the consensus, so that's what most people would predict, by bringing down interest rates, we would expect the dollar to go down, which might force the hand of the Bank of England and the European Central Bank to lower rates at the same time, even if they're not in as good of a position to do so, just to make sure that they don't have escalating currencies to the dollar. But the dollar is going to go first. The US is going to go first. So I would expect the pound and the euro to go up some until they're able to react on that back half of things. Expect some consistency to last year because they're going to be all working in conjunction. They definitely talk to each other. They definitely do things behind the scenes that we don't know about. And therefore, I would expect them to act together on that universal front so that we don't see their currencies flow in as big of ways as would completely destructure the overall global marketplace.
Mm-hmm. And just to give some clarity here to our audience, when you're looking at the charts, although the Chinese yuan and Japanese yen seem to be going up, it's inverse. So essentially, if it's going up, it means the currency is getting weaker. And if it's going down, it means the respective currency is actually getting stronger. So just throw a curveball in there. Naturally, the orange line and the purple line, depending on how it shows up on your screen, the euro and pound, that's normal as is. So if the numbers are going up, the currency is strengthening, and if it's going down, it is weakening. So just clarifying that for our audience here. Perfect.
Just to remind everybody, a weaker dollar is going to be good for global equities because the majority of global equities are American, 57% of the world, and a weaker dollar means all of those foreign earnings come in at better prices in the US. Hence why we're believing that the equity markets are going to do well because the dollar is going to weaken some this year.
On that aspect, actually, Brian, what are the statistics? I think it's almost like 40% of the S&P 500 has earnings attributed to international, and the tech sector, I believe it's even higher.
The tech sector is up to 60%. And why we care so much about the tech sector is naturally the S&P 500 is being driven by the tech sector. So the majority of the earnings and the growth of the S&P 500 comes from those Magnificent Seven. So with 60% of their earnings coming from abroad, instead of 40% for just the general S&P 500 or the S&P 493, if you want to dub them that, essentially means that we can continue to have earnings growth next year, just on the back of the dollar going down.
Perfect. Moving along onto our next topic here, which is the renewable energy sector and COP28. Why don't you give us some background here, Isa, on how the renewable energy space has done in the last year, and particularly some of the announcements that came out of COP28?
Yeah, definitely. So the renewable energy sector last year has not done all that great. Now, if we take a step back, in 2007, the first country actually announced that their target was to become carbon neutral. That was Costa Rica. 8 years ago, in 2015, we saw the Paris Climate Agreement happen, where 195 countries signed with the same goal to become carbon neutral. Now, that all is a strong indicator that renewable energy should thrive and should do well. But yeah, as I mentioned, last year wasn't all that great. Partially, that is due to the increased interest rates. Renewable energy companies tend to be more tech heavy than traditional fossil fuel energy companies. And because of that being tech heavy, they rely on more upfront capital. And that naturally is highly impacted by increased interest rates. So everything just got way more expensive for those firms. And that's why they have just, not had the same kind of success as they had before. Nevertheless, we know governments continue to support those companies with subsidies, and they try to stimulate those investments. We also see different governments stimulating private investments, for example, by giving house owners subsidies or tax cuts on investments in those renewable energy or those infrastructure renewables. And also in China, we've seen one of the electric car makers, BYD, one of the big competitors to Tesla, which is now also aiming at selling their cars in the emerging markets. So also the emerging markets are going to start to leverage more on those electric vehicles. So we will continue to see those new innovations in the renewable sector, and therefore we don't think this is the end of it, but this is just a little drop there, but it will continue to grow.
I mean, apologies for the audio issues there. I mean, if we go back to the renewable energy space and what you just mentioned there, Isa, last year was a bit of a difficult year, as you mentioned, for the renewable space as a whole. But if we move on to our next slide and bring it back to the US, particularly around the Infrastructure Investment and Jobs Act of 2021, that was a huge bill that was approved and signed into law on the 15th of November in 2021. And this is funding that's already been pre-approved. But what many people, I think, don't tend to follow quite closely is not all of that funding has actually been allocated. So what we're looking at right here on the slide is the 550 billion, which has been approved and for the Infrastructure Investment and Jobs Act over 5 years, and its breakdown depending on the different sectors and different components there. Now, if we actually look at how much has actually been spent or utilized so far on the next slide, only about 214 billion of the total 1.2 trillion has actually been allocated. So if we look at the renewable space going forward, as Isa mentioned, the prospects for a lot of those names and players in that industry is still quite strong, just because there's still a lot of funding to go around. And maybe Brian, you can chime in here as well. But with an election year in the mix, potentially you would imagine that the incumbents will want to approve more of that funding as we get closer to the election.
Absolutely. Any stimulus spending, as Josh astutely pointed out earlier, what we would expect is that if we have a strong economy, it's going to be good for Joe Biden to get reelected. And naturally, if we have a lot of more stimulus spending or the rest of the Infrastructure Investment and Jobs Act budget spent out, that's going to stimulate the actual U.S. economy to have a good year. So I would expect that that's been held there in reserves to make sure that we don't fall into a recession halfway through this year.
Perfect. I think moving on from the renewable space onto something completely different and on the other end of the spectrum, we originally touched upon politics in the beginning half of this presentation, but there's a lot more than politics going on in the global sphere, Josh. So why don't you take us through some of the chess pieces that are being moved around on the global stage and why we as investors should be paying attention to them potentially?
Yeah, absolutely. So a lot of what we've talked about, so we've kind of painted the picture of this is an election year. There's things that can change a lot between now and these respective elections, what's happening in the US. It's not just about the US, though. Now, as for the state of the world from this vantage point, at this point in time, there are 22 armed conflicts which are ongoing. Now, the most talked about one at the moment, I think it's fair to say, is the crisis in Gaza between Israel and Hamas. Now, what's going on there is horrible, and we hope sincerely that both sides find a way to resolve this latest chapter in the violence. However, from a market perspective, it's not ultimately consequential. But this contrasts with what's going on a bit further south, closer, well, in actually the Red Sea, given the Houthis in Yemen, who continue to interrupt global trade due to their proximity to the Suez Canal there. Now, that's about 15% of the world's shipping traffic, including roughly 30% of global container trade that passes through there. So in other words, they stand uniquely positioned to interfere with global supply chains, which is what we're currently seeing right now. Now, the big question mark there is how long they can continue to do this, because there's so much global trade going through Suez. And so there's the potential for that inflationary pressure on supply chains and logistics pretty much worldwide. But also just across the way from Yemen is Djibouti. Now, why is that relevant? So Djibouti actually has quite a few military bases from a lot of prominent nations based right there. That includes the US, the UK, Japan, China, Saudi Arabia, and a couple others too. The majority of these would be understandably keen to put a stop to the difficulties facing international trade as a result of the Houthis' actions. And so they'll be well stocked to try to address that threat to temper down the implications there. So that'll be the main one we're watching at the moment.
So if we bring all of this back in on how this essentially affects the markets overall in some of the key sectors here. So if we move along to our next slide here, Brian, maybe this one's for you here. Why don't we unpack what it is that we're looking at and why it's important for the audience, and then I think we'll launch into our next poll here as we're doing so.
Well, this is our periodic table of investments, which just breaks down shorter term and longer term how different investments have performed. So if we go all the way to the right, that's the 10-year total return of different asset classes. So U.S. growth stocks have done the best, and commodities have actually been negative performers. Now, essentially going into the new year, we kind of want to break down and we kind of know that this is about the expectations that we would have going forward, maybe with a few little differences. Essentially, starting from the bottom, as inflation comes down, we'd expect commodities to continue to to do poorly. And then the bond markets, essentially, as Cam astutely pointed out, we expect interest rates to go down. So owning long-term bonds is going to be a better way to be able to profit than just having shorter-term bonds like we were able to last year. So we're going to be going a little bit longer duration there. Emerging markets might not be the best performers because there is a mix out there across the board. India seems to have been doing gangbusters, but they're more expensive than US equities by several metrics. And that seems kind of expensive for an emerging market country. Meanwhile, many of the other BRICS are still in a position that they're not investable or as attractive as they should be. You still can't touch Russia. China still has many problems with their debt and the likes, which makes things very, very cheap. But at the same time, the politics could get in the way of that having a potential recovery this year or next. So we've got many emerging markets that don't have the opportunity to grow out of this very, very quickly. Basically, the developed world outside of the United States doesn't have the asset mix of having a huge allocation to technology like US growth does. And real estate is in the position that they're still trying to recover from those higher interest rates, therefore in a problematic territory. The last one that I'll go into is small cap. We'd like to have a bigger allocation to small cap. This is the first time that I've ever known yields on small caps companies being higher than large cap companies. But while we're enjoying it and keeping our current allocation, we're not increasing our allocation yet because mid-year this year, we would expect a lot of the debt for small cap companies to come due, and therefore they'll have to refinance at these higher rates. So we'll feel much more comfortable after that happens, after we see some of the smaller players fall off. That should hopefully give an opportunity to build a bigger position in small cap companies. So lots of opportunities, but lots of the same, Cam. This is why we've really built our portfolio to be very tried and true boring, which is heavy on US equities, on the equity portion, and our fixed income to be extremely boring, i.e. not taking any risks when it comes to high yield or the likes, when it comes to who we're letting borrow the money for our fixed income.
So to land the plane here and open it up for Q&A for our audience, I know we're a little short on time. So for some of the key aspects, on updates to the portfolios and what it actually means for our clients, as Brian mentioned there, we're increasing the duration or will be increasing duration on a lot of the fixed income for our clients, in addition to an introduction to buffer funds, and also parts in the renewable energy space, as Isa mentioned there, and as I covered earlier. We'll open up to Q&A here, and as we're waiting for some of the questions to come through, I've got a question for you, maybe on behalf of the audience here, Brian. But what is a buffer fund?
Buffer funds are essentially a fund that will buy, for instance, the one that we've been using, into US equities, and they're going to sell calls and sell puts around the current market position. What this does is it makes it so that we end up making more money than the market if the market's quite flat or quite stable. We lose less if the market drops significantly, but we also lose some of the upside if the market takes off significantly on the upside. The big reason why we've been using these buffer funds and we've been building up our positions in them is, simply put, we expect the markets to do all right this year, but we're not expecting 20 to 30% returns. Therefore, if we're wrong, we don't mind giving up that top end, but we doubt that we'll see that. We'd rather have the enhanced returns for a more sideways marketplace.
Perfect. Once again, ladies and gents, please do put your questions either in the chat or using the Q&A function here. We'll wait a few more minutes to let some questions trickle in, but we've got one here from Robert. The renewable electric generation sector seems to be constrained by transmission line, particularly in California, is the example he gives, to move power from the locations where it's actually generated to where it's actually used. Do you see any breakthroughs on new power transmission line installations in the US? I'll let either or take it.
Breakthroughs are slow and steady, and naturally that's one of the biggest problems when it comes to energy in the United States, is that we have three separate power grids. For all intensive purposes, there's one on the East Coast, one on the West Coast, and then there's Texas has their own. Now you'll remember Texas had their major problems from energy shortfalls a few years ago. Until you have a fully integrated system, you're not going to be able to prevent something of that sort. But we had a huge push through. I think it was in kind of some of the Midwest states of some large investment made to enhancing some of those structures. But it really needs to get to the granular level where essentially everybody that's producing can get those through, and not as much as lost on those systems. And that's going to take decades. That's going to take multiple administrations making a giant effort of this on a much bigger scale. So it will take time. It will take effort. We're not quite there yet, but at least there's nice pieces coming into place.
And to add to that part, I think if we look at the Infrastructure Investment and Jobs Act, a lot of billions have been allocated to transmission lines as well. Now, whether that funding actually materializes in some of those projects actually getting started, I think that's a different question, and has a political element to it as well. But the funding's there. It's a question of actually putting boots on the ground, I suppose.
It definitely keeps the cost down to get started. Richard's got a nice question. When does climate change impact investments and investment strategy? I think it already has. If we look at the size of the investment universe from 2015 to now, it's increased by 50%. It's expected to increase sixfold by 2030. Essentially, most any company that is not thinking about climate change when it comes down to it are missing the boat, because it will either become a huge liability or a huge missed opportunity. And we can think about that even just in the past. Through the 80s and the 90s, most of the large energy companies, didn't matter if it was BP, Exxon, Chevron, were some of the biggest investors in clean energy. Because the multiples were higher on clean energy than they were on dirty energy, most of them sold them off. You'll probably remember a campaign that BP ran was Beyond Petroleum for a long period of time. They are actually the owners of the Irish wind farms, the Irish Sea wind farms, which is one of the biggest wind farms here in the United Kingdom. And so they're going back into that. And I think that's just kind of that evolution that we're going to see. Big investments into it. And then if they get the higher multiples, they call it a waterfall view when it comes to investment banking. They're going to sell off those things that are a higher multiple because the company's worth more in parts than it is as a full. So it's not that they don't want to be clean. It's just that it's better to segregate the company into two different parts. But essentially across the board, most every company is taking on a view of sustainability and long-termism. And I expect that to continue to be the case. Like Isa did in her presentation, which is brilliant to think of what COP has really done for the overall marketplace, that 75% of countries are now wanting to get to being carbon neutral. To do that, all that in 2 short decades speaks quite loudly.
Perfect. We've got another question here from Kimberly. As AI takes on more of a customer service role, and then that was previously done by humans across industries, what impact do you anticipate this automation will have on unemployment rates? First in the next 12 months, and then more of a longer period over the next 5 years.
I don't see this as a doomsayer. I think 100 years ago we had people going down and digging coal. Then all of a sudden, as that got automated and we found cleaner energies, yeah, people got out of the coal mines, but we didn't lose jobs. We found different jobs because we became more productive as a society. If we look at the 50s and 60s, every single person in an office had a secretary just typing out letters and doing lots of mundane things. Now we do all of that ourselves. We don't really even mail letters because it's pretty much all automated. It's gone to emails and such, but that hasn't led to more unemployment. When I think of AI, I think the amount of potential output of code that can come from AI is astronomical. Now, Cam, you're our resident IT guy. Have we ever met the demand of the amount of programming that's requested or needed? Probably
Absolutely.
not.
I think if you talk to a lot of tech leaders in the space, I think one of the things everybody points out is the chronic shortage of programmers. And again, as Brian was pointing out there, and to Kimberly's question, I think AI is going to be more of a tool to a lot of individuals to help with their day-to-day roles and aspects. And as Brian mentioned, it'll lead to new roles being created that we can't even imagine yet. And that's the longer term 5 year plus horizon. And in the short term, in the 12 months, if we look at unemployment in Europe, the US, or UK, we're at historic lows. So I think AI will probably be a net benefit than the doomsday scenario that many have.
Now, what you have to remember is that while it will probably increase employment, increase, not decrease, it can lead to lost generations. In other words, technology will essentially lead to hiring more and making it easier for youngsters to come in at higher positions, higher pay. There will be constituents that essentially lose their opportunities because they're undereducated or not able to revamp their careers into something that is sticky. And I do believe that our governments have to be ready for that to re-educate that crowd, to try to get them back into the employment mix in other ways. Otherwise, they will face problems, but it's not statistically going to cause those problems in our economic numbers that are going to hurt society as a whole.
Hopefully that answered your question there, Kimberly. I think we're running up for time here, but we'll see if we get one last question come through. Oh, we do. We've got one from Robert, which is, will labor shortages continue to be a constraint? I think we'll take this last one here. Brian, what are your thoughts there?
Well, I think it's one of the best problems to have, that labor shortages are going to be that constraint. This is a problem of the baby boom generation getting to retirement. We went from at the beginning of the Obama administration, we had, I think, 71% of people in the United States that were actually paying into the system instead of taking out of the system. Now it's down to about 66% of Americans are paying in versus taking out. That 5% difference is not people that have lost their jobs. It's people that have gone into retirement. We expected that with the baby boom generation. That's going to last until, sadly, that generation passes on and things normalize. But we also now have the problem that we have a reduced birth rate across most of the world. China's come big in the news when it comes down to that. And naturally, that can cause more constraints from that vantage point. Hopefully, most of these will be worked through in the developed world from immigration and technology, as we've seen in the last years. But we never get to perfect employment. It's either one side or the other, and I would prefer this side rather than a drastic unemployment level. So maybe some more relaxed policies, some more cross-border business, will help from that vantage point, but that progresses over the course of time.
Perfect. And with that, we are now at time. Once again, I want to thank our audience here for attending. A recording will be made available afterwards, and we'll be sending a follow-up with the material, as well as some of the addendum items that we weren't able to cover today in detail for your review. As always, if there are any questions, please do let us know, and more than happy to take them later on offline. But other than that, I want to thank Brian, Josh, and Isa here for their insights, and thank you to the audience for tuning in.
Thanks so much, Cam.
Thank
Thanks,
you.
everyone.
Thank you.